So I came across an interesting article today that I want to share with each and every one of you. In there, they discussed 7 reasons why the stock market has continued going up over these past few weeks, and we're nowhere near the bottom that we've hit back in March, despite all of the issues going on in the economy right now. And what I want to do is just kind of add my little twist here and give you my thoughts on each of these 7 reasons. So I think this video is going to be interesting for you out there, whether you're a bull or a bear. So all I ask is, if you enjoyed this video, hit that like button down below. And if you're brand new here, consider subscribing and hit that bell notification as well so you see more videos from me when I upload them. So the S&P 500 is up nearly 27% in a month, and this has many investors scratching their heads as to how this is even possible despite all of the bad news in the media. The global issue isn't getting any better, we don't have a vaccine or cure, and millions of jobs are being lost not only in the US, but on a global scale. Yet, the market is up in the last month, which has many investors stumped. Keep in mind though, from late February to late March, we did drop roughly a whopping 35%, which was a huge shock to the system and caused a ton of people to panic sell their investments. During this time, the bears were enjoying this sharp decline because there was a lot of money to be made on this extreme fear and volatility. But now, well, these bears are getting squeezed and they aren't happy. So let's go over some of these reasons from this article why things have maybe turned bullish now, and the bulls may actually have a chance to make a lot of money here going forward. The first reason is that big, steady, secular growth stocks across technology, healthcare, and consumer staples are holding things together. Now, I completely agree with this statement, and let me show you why. Looking at the top 13 largest companies in the S&P 500 here, we can see that 12 of them fall in one of these 3 sectors. The only exception really is JP Morgan Chase, which of course is a financial stock. Now, these 12 other companies make up nearly 30% of the S&P 500 index, so naturally, if these stocks are holding up, the general market will hold up as well. So when it comes to the first reason here on why the stock market is not crashing right now, I completely agree that technology, consumer staples, and healthcare are holding up the current market. The second reason is that large companies that make up the index tend to have reliable access to capital and can weather through the storm more than small businesses. They also provide an example here with Amazon, stating that its $1.2 trillion market value accounts for over 40% of the entire value of the S&P 500 consumer discretionary sector. Now again, this ties into the first point, which I agree with and makes perfect sense to me. The largest giants are holding up because they're actually not getting hurt as badly during this global issue. In fact, Amazon here is thriving and they are struggling to keep up with demand, and as a result, the stock is up and their weight in the sector plays a bigger role. Moving on, the third reason is that analysts forecast a mild earnings hit, predicting companies that make up the S&P 500 will experience only a 8.5% decline in earnings in 2020, with revenue falling a mere 0.1%. Now here with this point, I think it is kind of debatable. I'm not really sure I agree with them here. In my opinion, I think that a lot of companies, including the S&P 500 giants, will experience some sort of slowdown in growth here in 2020. Now, a lot of companies won't only see the slowdown in growth, but they're probably also going to see some declines in growth and declines in earnings, and I think it's going to be much more than what the analysts are expecting. So far, we're seeing companies report their Q1 earnings, but the thing is, guys, in Q1, there was only about 2 weeks that were really affected in those earnings reports. The end of March, around the last 2 weeks of March, is when things actually started getting bad. Countries and cities started getting into lockdown mode, and that's when revenues really took a hit. Yet, even though it was just 2 weeks at the end of March, a lot of businesses did see a quite significant drop in their revenues and earnings from that quarter. Now, this is because a lot of companies, and the way business is done with larger companies, is that they push bigger deals typically towards the end of the quarter, and they try to close it off before the end of the quarter to hit their targets for estimates and all that kind of stuff. However, in this case, the end of the quarter seemed to have been the worst possible time because, like we said, things went into lockdown mode. And as a result, I think a lot of businesses that were considering closing deals probably pushed out their spending into the back half of 2020, resulting in a lot of companies realizing big revenue misses and probably profit misses as well. And like we all know, April has pretty much been a wash. All companies have been pretty much working from home or shut down completely depending on their sector. and may be a bit different. We may have about a couple of weeks of lockdown and then things start opening up. We'll have to wait and see how that plays out. But the true extent of this issue is really going to be seen in Q2 in my opinion. And right now the market may be optimistic on that, but we'll have to wait and see how Q1 earnings and guidances go for a lot of these companies. I know a lot of them are pulling guidance right now, so we may not get too much information, but we are getting tidbits of information from some of these large companies like IBM and Intel on how corporate spending is going, consumer spending is going, and we can kind of make better estimates for 2020 after this current earnings season passes by. Now, the fourth reason is that investors may be pricing in somewhat of a speedy rebound compared to the structural issues at play in 2008. Now, again, with this point, I agree because I can't count the number of times I've heard the term V-shaped recovery. This implies a sharp decline, but also a sharp recovery. And what we're seeing thus far from the lows is exactly this playing out. But the real question, of course, is will this V-shaped recovery that we're starting to see right now continue on with stocks making new all-time highs in the next couple of months? That is a real question. I don't believe we're going to see that soon, but I think that earnings seasons will give us a better idea of what we can expect for the rest of 2020 and possibly in 2021. Reason number 5 is that technical factors suggest short squeeze dynamics in which an upturn forced investors betting against those companies to close out their positions. Again, with this point, I tend to agree, especially when it comes to retail investors. The market sentiment was extremely bearish back on March 23rd after the famous Bill Ackman interview of doom and gloom, and I think a lot of retail investors loaded up on short positions and puts, and then once things started to recover from that point, they quickly tried to cover their shorts, leading to much more buying in the market, and probably even picked up some call options because now at this point they see a lot more optimism than pessimism. Now, retail investors may be right or wrong, we don't really know how things will play out, but it is a fact in my opinion that a lot of retail investors, hedge funds, probably even some of the best investors of all time were feeling extremely bearish in March, which is when we found the bottom, and ever since things started to recover, they realized maybe they were wrong, they started closing out their positions, and that just led to even more buying pressure. Reason number 6 is around the actions taken by the Fed. Things like expansion of asset buying, money market interventions, lending facilities, and pushing down longer-term interest rates. Don't fight the Fed. I'm sure you've heard this saying in the last few weeks. And this essentially means that investors believe now that the Fed has come out and said that they will do whatever it takes to support the market, that the market has a higher chance of a quick recovery. Now, the Fed is not directly buying equities here, so don't get that mistaken because a lot of you guys think Fed's coming in and buying stocks directly. That's not happening right now. However, they did state that this isn't off the table if required, and this is what's scaring a lot of bears right now. And rightfully so. If the Fed pretty much said, you know what, nothing's off the table here, we'll do whatever it takes to make sure that the market does recover, I personally would not be betting against that. I personally would not be shorting the market right now. And I think a lot of investors that were short realized this and started covering their positions, which has just led us to higher prices and a quicker recovery than expected. Now, I agree with this point overall. I don't think that you should be fighting the Fed per se. However, in general, I am a bull. I am a bullish investor. So either way you look at it, this kind of plays out in my favor regardless. The 7th and final reason here is around the unemployment rate and an alternative view on the horrible number of record jobless claims can even be viewed as helpful to the market. This is because both sides of the aisle come together for gigantic stimulus measures. I mean, guys, this is quite likely what has happened here because we seem to rally whenever there is a job report on jobless claims showing us that the market just doesn't care how many millions of Americans are currently out of a job. Now, how long will this continue for? Your guess is as good as mine, but I think if we continue seeing a few million new claims every single week as we go into mid or late May, that's when the market will probably start to pay a lot more attention to this, because in my opinion, it seems like all of this right now was expected, and the stimulus was something that just kind of came out of nowhere from the government to help a lot of these people, which has never really been seen before. But who knows, guys, we may see multiple rounds of these stimulus checks come out to Americans. So even if we continue to see massive job losses, it may not make too much of a difference to the stock market here. Who knows how this plays out, but guys, there's no point trying to time the market and make predictions on what's going to happen with the next jobless claim numbers, Because more often than not, the market's going to do the opposite of what you believe it's going to do, and you're going to end up losing a lot of money. What I'm personally doing is exactly what I continued doing in 2019, and that is just buying stocks that I find value in. Although a lot of companies have recovered quite a bit from their lows and their valuations may seem expensive right now, there are still a handful of businesses, in my opinion, that are still very attractive at their prices today. Good examples of that would be Disney and Starbucks, which are still off quite significantly from their lows. Now, do we believe that the issue we're going through right now is going to be something that's permanent and people are never going to go out to a Starbucks ever again, or people are never going to go to Disney World again? I think that kind of speaks for itself. You guys know the answer to that question. And over the next few years, things will recover in these industries as well, and stock prices will get back to, if not higher than they were back in Jan 2020. I'm confident that looking back at 2020, say 3 to 5 years from now, we'll all think, oh, I wish I put more money into the market. Oh, I wish I did things differently. Oh, I wish I invested in this company versus that company. But guys, try not to have any regrets. Remember, every past recession that we've had, people have said, I wish I did so and so. So make sure you're not stuck in that situation. Don't wish, make things happen, make decisions. As long as you do your research and have a long-term outlook on these businesses, things are poised in your favor to work out. But either way, let me know in the comment section down below if you agree with these 7 reasons from this article and with my opinions on these 7 reasons as well. I'd love to hear your thoughts in the comment section down below. But keep in mind that just because things start to look better now does not mean that we can't see another big sell-off in the market in the coming months. Anything's possible. I'm prepared for it. I hope you guys are prepared for it. But either way, guys, remember, long-term is what I'm focusing on, and I think that's the way to go. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one. Peace.